Hello and welcome to Legal Wrangle on Direct Tax. Today we bring you 6 cases relating to wealth tax, business income, non-compete fee, denial of exemption if an educational institution is making profits, and cash adjustment against advance tax dues. Our first case is a Supreme Court decision on wealth tax, which may be off the statute but very much a part of your tax declaration.
The assessee company is Kapri International.
The question before the Supreme Court was when the assessee had given a portion of its property on rent to its subsidiary company. Will this property be included in the total wealth of the assessee, especially when both the companies treat each other as separate entities? There was another question involved in the same case, which was whether the license fees received by the assessee from its subsidiary for hiring out a part of its factory, was it business income? If it was, then business expenses could be claimed against the license fees under Section 37. Tricky, huh? Let's hear the facts from Maneet.
The assessee company manufactured bed covers and napkins with the help of its subsidiary company, Dior International, which was under the same management. The assessee had given out a part of its factory building to Dior International, which used its own machinery for cutting and dyeing the fabric exclusively for the assessee. The assessee charged Dior International a monthly license fee for the premises. The assessee claimed the same license fee as its business income. The tax authorities disallowed the claim, holding that the part of the building given to Dior International was not being used for the assessee's own business. It was also held that the portion of the factory rented out to Dior should be referred to a valuation officer to be included as the net wealth of the assessee because it was being used by Dior for its own use of manufacturing activity. The assessee was not using it for its own business of manufacturing as factory.
The matter came up before the Supreme Court, which agreed that the assessee was the user of the building and this asset was being used productively. However, this was only partially true and the decision went in favor of the revenue.
The court held that expenditure must be incurred for the purpose of carrying on the business of the assessee, and it must be the assessee who must incur the expense as the person carrying on the business. Both the companies were separate entities and the leased portion of the building was not being used by the assessee for its own business. Hence, it was rightly included as the net wealth of the assessee.
True, the business of the subsidiary company cannot be considered as the business of the parent company. Our next case is also a Supreme Court decision on commission payments as business expenses. The Apex Court also considered the authority of the High Court to set aside the tribunal's order.
The assessee is Premier Breweries, a manufacturer of alcoholic beverages.
The question before the court was whether mere acceptance of proof provided by the assessee of commission payments made, the agreements with the agents, will it debar the assessing officer from questioning the allowability of expenses claimed under Section 37. Maneet has the facts of the case.
As a manufacturer of beer and alcoholic beverages, the assessee had to compulsorily sell its products to state corporations, which were exclusive wholesalers, and sold these alcoholic beverages to the retailers. To ensure a continuous supply of goods, The assessee had hired a couple of agents to coordinate with the retailers and state corporations and claimed Section 37 deduction on these commission payments. The assessing officer questioned the very existence of one of the agents. For the other, he queried why would the assessee appoint as agent one who lacked the infrastructure for the job and had entrusted another agency for the assessee's job. The AO thus allowed the assessee's claim, holding that it had not discharged the burden of proof to be entitled to the deduction.
The High Court accepted the agreements executed by the assessee with the commission agents, the affidavits filed, as well as the payments made to the commission agents. It noted that certain government circulars regulated, if not prohibited, manufacturers from liaisoning with government corporations for obtaining supply orders. Considering the facts, the High Court reframed the questions of law and set aside the tribunal's order.
The High Court held that the tribunal had committed a grave error in not properly understanding the transaction between the assessee and others. The court reframed the question of law and ruled in favor of the revenue. It set aside the tribunal's order and upheld the commissioner's order that the assessee had failed to discharge its burden under Section 37.
The assessee approached the Supreme Court and challenged the High Court's actions in reframing the questions of law after conclusion of arguments and setting aside the tribunal's order, which the court had no power to do, even if it believed the tribunal's conclusions to be incorrect.
The Apex Court concluded that the High Court setting aside the tribunal order was an error of form, not substance, as questions arising in reference were specifically answered. The Supreme Court held that to determine the assessee's entitlement to Section 37 deduction, the High Court had considered the true effect of the government circulars, along with the assessee's agreements with the commission agents and the affidavits filed by the husbands of the partners of the commission agent, whose very existence was doubted by the AO. No fault could be found in the questions reframed by the High Court and the answers provided. The assessee's appeal was dismissed.
Well, the assessing officer always has the power to question whether payments are properly deductible.
The individual assessee is an expert in industrial design and development of power electronic equipment.
The question was whether payment of non-compete fee by a foreign company to the individual assessee may be treated as payment in lieu of salary. Maneet is cued on the facts of the case.
The individual assessee, along with a colleague, had started a private limited company, RSM Electronics, for manufacturing of industrial drives, which was doing reasonably well. Subsequently, in September 1993, a UK-based company, Control Techniques, along with the assessee's company, formed a joint venture company in India with 51% shareholding being held by the UK company. The assessee then became an employee in the Indian joint venture, which paid him salary. Eventually, in September 1995, following government approval for change in shareholding pattern, the UK company's stake in the joint venture was increased to 85%, while the shareholding of the assessee's company was reduced from 49% to 15%. In December 1995, to ensure there was no competition following reduction in share capital, the UK company also paid the assessee a non-compete fee not to carry on the business of the industrial drives. The assessee showed the salary and income as the director in the Indian joint venture. The non-compete fee was claimed as a capital receipt exempt from tax and entitled to immunity from the capital gains as cost of acquisition was nil. Tax authorities concluded that the directors in the assessee's company had become directors in the Indian joint venture. Thus, on the date of the non-competition agreement, neither the assessee nor his old company was in position to compete with the Indian joint venture. Thus, a non-compete fee received from the employer was profits in lieu of salary under Section 17(1).
The matter came up before the Madras High Court that ruled in favor of the assessee. The court followed an apex court decision holding that compensation received for loss of agency was a revenue receipt, while compensation attributable to a negative covenant was a capital receipt, but only until assessment year 2003-04. A liability could not be recreated retrospectively. Thus, non-compete fee received only after April 2003 was taxable under Section 28 VA.
The High Court held that the assessee's expertise was a potential threat to the foreign company, which had entered into the non-compete agreement. This payment was, by no stretch of the imagination, a payment in lieu of salary. It was a capital receipt.
Well, expertise and the fear of competition may bring in some unusual benefits. Our next case is a Supreme Court decision in the case of an educational institution.
The assessee is Queen's Educational Society, a non-profit educational institute.
The question before the Supreme Court was, when a non-profit institution generates surplus, will it be treated as a profit-making enterprise to be denied deduction under Section 1023C? Maneet has the facts of the case.
The assessee had shown net surplus for 2 assessment years, which were ploughed back into the purchase of assets for education. The assessing officer denied the assessee's claim for exemption under Section 1023C by holding that the assessee was established for the sole object of imparting education, but had become a profit-making enterprise.
The matter came up before the apex court, which held in favor of the assessee.
Supreme Court held that when surplus is ploughed back into educational assets, the educational institute exists solely for educational purpose, not for profit. It ruled in favor of the assessee.
The apex court also held that tax authorities need to continuously monitor the genuineness of such institutions to ensure that their income was applied in accordance with law. It warned that if such institutions were not operating as per conditions subject to which approval was given, the approval and the exemption must be withdrawn. Our fifth case is the decision of the Karnataka High Court on Section 54F exemption.
The individual assessee owned immovable property in Bangalore.
The question was whether improvement expenses incurred after acquiring a habitable asset are eligible for Section 54F benefit. Let's request Maneet for the facts of the case.
The assessee purchased habitable property from her share of proceeds on sale of immovable property in which she was co-owner. The newly purchased property was habitable but lacked certain amenities. The assessee thus incurred improvement expenses on change of flooring and other alterations. She declared capital gains on sale of property and claimed the Section 54F benefit. While computing the indexed cost of acquisition, the assessee included these improvement expenses and took the fair market value of the property higher than the value as per the government notification. The tax authorities reopened the assessment, holding that the fair market value was lower than that computed by the assessee, and thus the assessee had overvalued the asset and income had escaped assessment. Improvement expenses were disallowed by concluding that the property was already habitable.
The High Court concluded in favor of the assessee that expenses incurred on improvement of a habitable asset are eligible for Section 54F exemption.
The High Court held that the department cannot be prevented from reopening an assessment when it had sought further clarification of the reasons for reopening as on the date of issue of notice under Section 148. The High Court held in favor of the assessee that expenses incurred on improvement of a habitable asset must be considered for giving benefit under Section 54F.
That was fair and square. Our last case in this episode is a decision by the Allahabad High Court relating to adjustment of advance tax liability.
The assessee is an individual who had failed to meet its advance tax liability.
The question was whether advance tax liability can be adjusted against the cash seized from the assessee during a search operation and lying in the revenue account. Another tricky question was, can interest be imposed against the assessee under Section 234 for failing to meet its advance tax liability? Maneet has the facts on her fingertips.
Huge amounts of cash were found and seized in search operation conducted at the residence and business premises of the assessee, including bank lockers. The assessee wrote to the tax authorities to adjust its advance tax liability against the cash seized. The assessing officer, however, charged interest under Section 234A, B and C, which was deleted by the appellate authorities.
The revenue appealed before the High Court, which also ruled in favor of the assessee.
The High Court held that revenue had seized cash from the assessee which was available with the department before the due date. As the assessee had requested adjustment of advance tax against the cash, interest was not leviable against the assessee either for default or deferment of advance tax liability. The High Court thus ruled in favor of the assessee.
Thank you for watching. Please email us your comments and suggestions at editor@tiol.in. Don't forget to subscribe to TIOL Tube channel on YouTube. Have a nice day.